Chapter 22 Real Estate Math. Introduction Objectives. In this chapter, we will discuss the math operations that you need to be familiar with. At the end of this chapter, you will be able to 1. Identify equations for, and compute real estate commissions, loan interest and points, and property appreciation and depreciation. 2. Identify equations for, and compute mortgage payments and real property area and length measurements. 3. Identify equations for, and compute mortgage underwriting ratios and add valorem and property transfer taxes. Key terms. There are some important terms in this chapter. Remember to pay particular attention to these terms when you see them. Acre. Interest. Commission. Point. Front foot. Principal. Gross income, net income. Real property tax rate. Hectare. The New York Bureau of Educational Standards requires that you spend 50 minutes studying the material in this chapter. Your course timer can be found in the upper right-hand corner of your screen. Percentages. Many of the calculations you will deal with in the real estate business involve percentages and formulas. Let's take a look at some of the more common calculations. Commissions. In an earlier chapter, we discussed compensation and commission splits, but did not talk about the formula used to calculate commissions. Commission calculations are done using the following formula: sales price X rate of commission equals total commission. So, if a broker sells a property for $250,000 and the commission rate is 6%, the commission will be $15,000. $250,000 x 0.06 equals $15,000. Another example, Jim sold a home for $176,900 and the commission rate is 7.5%. The commission on the sale is $13,267. 50. $176,900 x 0.075 equals $13,267.50. Your turn. Calculate the commission on the following sales. Then move to the next screen to check your work. 1. $95,000 sale at 7%. 2. $230,500 sale at 8.5%. 3. $312,000 sale at 6%. Percentages. Here are the correct answers. 1. $95,000 sale at 7%. $95,000 x 0.07 equals $6,650. 2. $230,500 sale at 8.5%. $230. 500 x 0.085 equals $19,592.50. 3. $312,000 sale at 6%. $312,000 x 0.06 equals $18,720. Interest. Most real estate loans use simple interest. Simple interest is money that is paid only for the amount of principal the borrower still owes. When the money is repaid to the lender, the payments stop. The formula for computing simple interest is interest equals principal x rate x time. Using the formula above, the interest rate on a $2,250 loan for 1 year at 7% interest is $157.50. $2,250 x 0.07 x 1 equals $157.50. This loan will be paid in 12 equal monthly installments of $187.50, plus a simple interest at the 7% rate. The first month's interest will be computed on the full loan of $2,250. However, the second month's interest will be computed on the new loan balance of $2,062. 50. Which is the original $2,250 minus the monthly principal of $187.50. Simple interest is calculated only on the remaining loan balance. We'll illustrate this more clearly when we talk about mortgage interest. Interest. Your turn. Calculate the total interest due on the following loan amounts. Then move to the next screen to check your work. 1. $3,000 loan at 6% for 1 year. 2. $4,200 loan at 5% for 1 year 3. $6,500 loan at 9% for 1 year 4. $7,275 loan at 8% for 1 year interest. Here are the correct answers. 1. $3,000 x 0.06 x1 equals $180. 2. $4,200 x 0.05 x1 equals $210. 3. $6,500 x 0.09 x1 equals $585. 4. $7,275 x 0.08 x1 equals $582. Appreciation. Appreciation is the amount that a property increases over time due to inflation, supply and demand, capital improvements, and other factors. Property can increase in value each year. To calculate a property's appreciation, you would multiply the property's original value by the percent of appreciation. Add the result to the original value. Example: a property was purchased for $210,000 and it appreciated 3% each year for 3 years. Here's how to calculate the new value after 3 years. Year 1 $210,000 x 0.03 equals $6,300. $210,000 plus $6,300 equals $216,300. Year 2 minus $216,300 x 0.03 equals $6,489. $216,300 plus $6,489 equals $222,789. Year 3 $222,789 x 0.03 equals $6,683.67. $222,789 plus $6,683.67 equals $229,472.67. So, the value of the property after 3 years would be $229,473. Depreciation. Depreciation is a loss in value over time due to wear and tear, physical deterioration, and age. Property, especially rental or investment property, depreciates every year based on what's called its economic life. The economic life is that time period that a building is expected to remain useful for its originally intended purpose. To determine the depreciation, you would divide the cost of the building by the number of years of its economic life, and the result is the annual depreciation amount. Example: a property costs $150,000. The land value, which does not depreciate, is $40,000. Leaving $110,000 as the value of the building. If the building has an expected economic life of 40 years, the annual depreciation would be $2,750. $110,000 divided by 40 years equals $2,750. Given the above calculation, the depreciated value of the building after 5 years would be $96,250. $2,750 x 5 years equals $13,750. $110,000 minus $13,750 equals $96,250. Points. As we discussed in an earlier chapter, points are items usually included in the cost of obtaining a new real estate loan. Points are a one-time service charge to the borrower for making the loan. There are 2 types of points. Origination points. Discount points. Points represent prepaid interest and the lender charges them to get additional income on the loan. Points are paid at closing and are usually equal to 1% of the loan amount. 2 points on a $75,000 loan would be $1,500. Origination points. Lenders charge origination points to recover some costs of the loan origination process. In many cases, a loan officer's compensation is based on the origination points. Depending on the lending institution, the origination points may be negotiable. Discount points. These charges are designed to offset any losses the lender might suffer when selling the loan to the secondary mortgage market. Discount points are a means of raising the effective interest rate of the loan. The rule of thumb is 1/8% for each discount point. So, a charge of 4 points would increase a 7.25% mortgage to a 7.75% yield. 4 points x 1/8% equals 4/8 equals 0.50%. 7.25 plus 0.50 equals 7.75% points. Let's do some calculations. Mark and Amy are getting a $120,000 loan at 8.5% and will pay 2 origination points at closing. What will the point cost be and what will the effective interest rate be? Point cost, $2,400. $120,000 x 0.01 x 2 points. Effective interest rate, 8.5%. But what if the lender was charging 2 discount points instead of origination points? How would that change the figures? The calculation for the point amount remains the same. Point cost, $2,400. $120,000 x 0.01 x 2 points. But now let's look at how the rate changes. 2 points x 1/8% equals 2/8 equals 0.25%. 8.5 plus 0.25 equals 8.75% effective rate points. Your turn. 1. Laura is getting an $85,000 loan at 7% and will pay 3 origination points. What will the point cost be and what will the effective interest rate be? 2. Bill and Jen are getting a $175,000 loan at 8% and will pay 4 discount points. What will the point cost be and what will the effective interest rate be? 3. Hal is getting a $65,000 loan at 9% and will pay 2 discount points. What will the point cost be and what will the effective interest rate be? 4. Neil and Jennifer will get a $285,000 loan at 7.5% and will pay 1 origination point and 2 discount points. What will the point cost be and what will the effective interest rate be? Points. Here are the answers. 1. Laura is getting an $85,000 loan at 7% and will pay 3 origination points. What will the point cost be and what will the effective interest rate be? Point cost, $2,550. $85,000 x 0.01 x 3 points. Effective interest rate, 7%. 2. Bill and Jen are getting a $175,000 loan at 8% and will pay 4 discount points. What will the point cost be and what will the effective interest rate be? Point cost, $7,000. $175,000 x 0.01 x 4 points. Effective interest rate, 8.5%. 4 points x 1/8% equals 4/8 equals 0.50%. 8.0 plus 0.50 equals 8.5%. 3. Hal is getting a $65,000 loan at 9% and will pay 2 discount points. What will the point cost be and what will the effective interest rate be? Point cost, $1,300. $65,000 x 0.01 x 2 points. Effective interest rate, 9.25%. 2 points x 1/8% equals 2/8 equals 0.25%. 9.0 plus 0.25 equals 9.25%. 4. Neil and Jennifer will get a $285,000 loan at 7.5% and will pay 1 origination point and 2 discount points. What will the point cost be and what will the effective interest rate be? Point cost, $8,550. $285,000 x 0.01 x 3 points. Effective interest rate, 7.75%. 2 points x 1/8% equals 2/8 equals 0.25%. 7.5 plus 0.25 equals 7.75%. Calculating mortgage payments. Although some real estate loans can be repaid annually, the most common repayment plan is monthly. As we know, a borrower is responsible for making those monthly payments, which include both principal and interest. Most typically, the borrower has a flat monthly payment, part of which goes to interest and the rest to principal. So how does the lender determine how much to allocate to interest and how much to principal? In the case of amortized loans, the lender calculates an amortization schedule that is based on the amount of the loan, the term of the loan and the interest rate. The amortization calculation produces a monthly payment amount. For example, Julie and Bob obtain a mortgage for $90,000 for 30 years at a fixed rate of 5.75%. When the lender runs the amortization calculation, the result will produce a monthly payment amount of $525.22. Using the example above, let's see how the lender allocates the interest and principal. Loan is $90,000. Rate is 5.75% per year. Monthly payment is $525.22. $90,000 x .0575 equals $5,175. Yearly interest due $5,175 divided by 12 equals $431.25. First month's interest $525.22 minus $431.25 equals $93.97. First month's principal. Now the lender will subtract the principal payment from the initial loan balance to arrive at the loan balance for next month's calculation. $90,000 minus $93.97 equals $89,906.03. Calculating mortgage payments. Let's do the calculation for the second month of Julie and Bob's mortgage. Current loan balance $89,906.03. Rate is 5.75% per year. Monthly payment is $525.22. $89,906.03 x .0575 equals $5,169.60. Yearly interest $5,169.60 divided by 12 equals $430.80. Second month's interest $525.22 minus $430.80 equals $94.42. Second month's principal. Now subtract the principal payment from the loan balance to arrive at the balance for next month's calculation. $89,906.03 minus $94.42 equals $89,811.61. And so it continues. Each month the lender repeats the calculation to arrive at the new principal balance and allocate what part of the payment goes to interest and what to principal. Note, as small as the changes may be, you can see that with each payment, the amount going to interest decreases while the amount going to principal increases. Your turn. Using the same process, calculate the third month of Julie and Bob's mortgage payment and arrive at the new balance. Then go to the next screen to check your work. Calculating mortgage payments. Here's the calculation for the third month of Julie and Bob's mortgage. Current loan balance $89,811.61. Rate is 5.75% per year. Monthly payment is $525.22. $89,811.61 x .0575 equals $5,164.17. Yearly interest $5,164.14 divided by 12 equals $430.34. Third month's interest $525.22 minus $430.34 equals $94.88. Third month's principal. New balance for next month's calculation. $89,811.61 minus $94.87 equals $89,716.74. Your turn again. Sally and Dan obtain a mortgage for $145,000 for 30 years at a fixed rate of 8.75%. When the lender runs the amortization calculation, the result will produce a monthly payment amount of $1,140.72. Calculate the allocation of principal and interest for the first 3 payments. Then calculate the total amount of principal and the total amount of interest Sally and Dan paid in the first 3 months. When you're finished, go to the next screen to check your work. Calculating mortgage payments. Here are the correct calculations. Month 1. $145,000 x .0875 equals $12,687.50 yearly interest due $12,687. 50 divided by 12 equals $1,057.29. First month's interest $1,140.72 $1,057.29 equals $83.43. First month's principal. Month 2. $145,000 minus $83.43 equals $144,916.57. New balance $144,916.57. X .0875 equals $12,680.20. Yearly interest $12,680.20 divided by 12 equals $1,056.68. Second month's interest $1,140.72 minus $1,056.68 equals $84.04. Second month's principal. Month 3. $144,916.57 minus $84.04 equals $144,832.53. New balance $144,832.53. X .0875 equals $12,672.85. Yearly interest $12,672.85 divided by 12 equals $1,056.07. Third month's interest $1,140.72 minus $1,056.07 equals $84.65. Third month's principal. Total principal paid $252. 12. Total interest paid $3,170.04. Area and length. Area is always expressed in square feet or square yards. Area of a rectangle. Area equals length x width. Area of a square. Area equals side x side. Using the formulas above, the area of a rectangular lot that measures 150 feet wide by 200 feet deep would be 30,000 square feet. 150 x 200 equals 30,000 square feet. The area of a square lot that measures 120 feet wide and 120 feet deep would be 14,400 square feet. 120 x 120 equals 14,400 square feet. The front foot of a parcel of property is the measure of the property's frontage on the road or highway or across the front of the property. If the front footage represents a substantial part of the parcel's value, for example an oceanside property, the property may be priced per front foot. In such a situation, the area that extends back from the ocean is left out of the calculation. For example, if a rectangular lot measuring 800 feet wide by 200 feet deep is offered for $20 per front foot, the asking price would be $16,000. 800 x $20 equals $16,000. Area and length. To compute the area of a triangle, use this formula. Area of a triangle. Area equals 1/2 base x height. The base of the triangle is the bottom and the height is an imaginary line from the top of the uppermost angle to the base. If the base of a triangle is 100 feet and the height is 50 feet, the area is 2,500 square feet. 1/2 equals area. 1/2 equals 2,500 square feet. Your turn. Compute the area of the following parcels of land. Then check your answers below. 1. Rectangular lot 190 feet wide by 150 feet deep. 2. Square lot 90 feet on each side. 3. Triangular lot 120 feet wide and 60 feet deep. Here are the correct answers. 1. Rectangular lot 190 x 150 equals 28,500 square feet. 2. Square lot 90 x 90 equals 8,100 square feet. 3. Triangular lot 1/2 and 1/2 equals 3,600 square feet. Area and length. Irregular lots or rooms. To compute the area of an irregular parcel or room, you will have to follow this procedure. Divide the shape into regular rectangles, squares or triangles. Compute the area for each figure. Add the areas together to get the total area for the parcel. For example, look at the irregular shape in the graphic. 1. Divide the parcel as shown. 2. Compute the area for each figure. 90x80 equals 7,200 square feet. 1/2 equals 1/2 equals 1,400 square feet. 3. Add the square feet together to get the total. 7,200 plus 1,400 equals 8,600 square feet. Other area and length calculations. Price per square foot. Once you figure out the total square footage of a home or parcel, you can compute the price per square foot by dividing the sales price of the home or land by the calculated area. Example: a parcel of land that is 150 feet wide and 100 feet deep and sold for $140,000 has a price per square foot of $9. 34. 150x100 equals 15,000 square feet. $140,000 divided by 15,000 equals $9.34 per square foot. Perimeter. The perimeter of a lot or other shape is the sum of the length of all its sides. An acre of land has 43,560 square feet. This is an important measurement and one that you should memorize. Oftentimes, parcels of land are measured in acres. If you know the acreage and one of the side measurements, you can figure out the other measurement by dividing. Example: an acre of land has a road frontage width of 120 feet. 43,560 divided by 120 equals 363 feet. So, this particular acre of land is 120 feet wide by 363 feet deep. If you know the square footage of a parcel of property, you can determine how much of an acre it is. Example: a parcel of property is 26,136 square feet. 26,136 divided by 43,560 equals 0.60 or 60% of an acre. Hectare. A hectare is a metric measurement. It is equal to 10,000 square meters, or approximately 2.47 acres. To convert acres to hectares, divide the total acres by 2.47. Example: a parcel of land is 40 acres. 40 divided by 2.47 equals 16.19 hectares. More area and length calculations. As we discussed in an earlier chapter, lenders will try to estimate a potential borrower's ability to fulfill the loan obligation by establishing debt-to-income ratio. The debt-to-income ratio establishes the borrower's capacity to pay the loan by limiting the percent of gross income he or she may spend on their total obligations, loans, student loans, other payments, and housing costs. Gross income is a person's total income before any deductions. Net income is the gross income minus expenses. These debt-to-income ratios are calculated using a front-end ratio used in all loans or a back-end ratio, total housing expenses divided by total gross income, used by lenders to calculate credit risk along with the front-end ratio. Housing costs include the principal, the interest, the taxes and homeowners insurance, and also may include some monthly assessments for mortgage insurance, HOA fees, and utilities. Current ratios may be located in each lender's criteria for loans, i.e. FHA, VA, Fannie Mae, USDA. You can locate the current ratios on these lender sites. Front-end or total obligation ratio: total monthly expenses divided by total monthly gross income equals TOR. Back-end or housing expense ratio: total housing expenses divided by total gross income equals HER. Let's look at an example on the next screen. Mortgage qualifying. Gary and Sue want to purchase a home for $92,000. Here are the facts, along with how the lender will calculate the front-end income ratio. Total amount of new house payment, $900. 00 Gary and Sue's gross monthly income, $4,000. Divide total house payment by gross monthly income, $900 divided by $4,000. Income ratio, 22.5%. Now here's how the lender will calculate the debt ratio. Total amount of new house payment, $900. Total amount of monthly recurring debt, $725. Total amount of monthly debt, $1,625. Gary and Sue's gross monthly income, $4,000. Divide total monthly debt by gross monthly income, $1,625 divided by $4,000. Debt ratio, 40.62%. These numbers will be calculated and compared to the criteria for the specific loan, FHA, VA, or conventional. If their debt ratio is too high according to the lending standards, they may not qualify for a traditional government-backed loan. Mortgage qualifying. Your turn. Calculate both the front-end and back-end income and debt ratios for this couple and determine their ratios. Jeff and Gwen want to purchase a home for $159,900. Here are their facts. Monthly house payment, $960. Total gross income, $3,500. Monthly recurring debt, $300. When you're finished, go to the next screen to check your work. Mortgage qualifying. Back-end ratio for Jeff and Gwen. Total amount of new house payment, $750. Anticipated taxes, insurance, and HOA fees $210. Jeff and Gwen's gross monthly income, $3,500. Divide total house payment by gross monthly income, $960 divided by $3,500. Housing expense ratio, 27.4%. Front-end ratio for Jeff and Gwen. Total amount of new house payment, $960. Total amount of monthly recurring debt, $300. Total amount of monthly debt, $1,260. Jeff and Gwen's gross monthly income, $3,500. 00. Divide total monthly debt by gross monthly income, $1,260 divided by $3,500. Total obligation ratio, 36%. When calculated and compared with lending standards for a loan, Jeff and Gwen will be determined as to whether they would or would not qualify for that loan. Do understand that the qualifications are different for different types of loans. Conventional, FHA, VA, USDA, and even non-conforming loans. Qualification will be based upon the loan that the consumer is seeking. Mortgage qualifying. Most real estate professionals need to know about the calculations for three kinds of tax. Real property transfer tax, mortgage recording tax, real property tax. Real property transfer tax. As we talked about in a previous chapter, sellers must pay a transfer tax when they sell their property. The tax is based on the purchase price of the property, except if part of the loan is assumed. In that case, the amount of the assumption is subtracted from the purchase price and the tax calculation is done on the remainder. The amount of the tax is $4 per $1,000 of purchase price. Example 1, sale price of the property is $575,000. Transfer tax is $2,300. $575,000 divided by $1,000 equals $575. $575 x $4 equals $2,300. Example 2, sale price of the property is $323,900. Assumed mortgage is $75,000. Transfer tax is $995.60. $323,900 minus $75,000 equals $248,900. $248,900 divided by $1,000 equals $248.90. $248.90 x $4 equals $995.60. Your turn 1. Calculate the real property transfer tax for a property that sold for $295,000. 2. Calculate the transfer tax for a property that sold for $410,000 with an assumed mortgage of $150,000. Check your answers on the next screen. Tax rates. Here are the correct answers. 1. $295,000 divided by $1,000 equals $295. $295 x $4 equals $1,180. 2. $410,000 minus $150,000 equals $260. $260,000 divided by $1,000 equals $260. $260 x $4 equals $1,040. Mortgage recording tax. As we learned in an earlier chapter, mortgages that are recorded in New York are assessed a mortgage recording tax. The tax is made up of several taxes added together and are based on the taxes that are in effect in the county or city where the property is located. The minimum tax rate is 75 cents for each $100 of the amount secured by the mortgage. The maximum amount is $2.75 for each $100. For purposes of illustration, let's assume the recording tax rate is $2.80 for each $100 of principal. If a person purchases a small apartment building in New York State and carries a mortgage of $950,000, the mortgage recording tax would be $26,600. $950,000 divided by $100 equals $9,500. $9,500 x 2.80 equals $26,600. Tax rates. Real property tax rate in New York State. The real property tax is a tax based on the value of real property. The amount of a particular property's tax bill is determined by two things: the property's taxable assessment and the tax rates of the taxing jurisdictions in which the property is located. The formula for calculating the property tax rate is assessed value x tax rate equals annual taxes. Example 1. If the assessed value of a property is $75,000 and the tax rate is $1.75 per $100 of assessed value, the taxes would be $1,312.50. $75,000 divided by $100 equals $750. $750 x $1.75 equals $1,312.50. Example 2. If the taxes on a property are $2,400 and the rate is $1.50 per $100, the assessed value of the property would be $160,000. $2,400 divided by $1.50 equals $1,600. $1,600 x $100 equals $160,000. Summary review. This concludes Chapter 22. Below is a summary which you can review before taking your quiz. Commissions. Sales price x rate of commission equals total commission interest. Simple interest is money that is paid only for the amount of principal the borrower still owes. Interest equals principal x rate x time. Appreciation is the amount that a property increases over time. Multiply the property's original value by the percent of appreciation. Add the result to the original value. Depreciation is a loss in value over time due to wear and tear, physical deterioration and age. Divide the cost of the building by the number of years of its economic life and the result is the annual depreciation amount. Points are items usually included in the cost of obtaining a new real estate loan. Points are paid at closing and are usually equal to 1% of the loan amount. Origination points to recover some costs of the loan origination process. Discount points to offset any losses the lender might suffer when selling the loan to the secondary mortgage market. Discount points are a means of raising the effective interest rate of the loan. Mortgage payments. A borrower is responsible for making those monthly payments, which include both principal and interest. In the case of amortized loans, the lender calculates an amortization schedule that is based on the amount of the loan, the term of the loan and the interest rate. The amortization calculation produces a monthly payment amount. Area and length. Area is always expressed in square feet or square yards. Area of a rectangle, area equals length x width. Area of a square, area equals side x side. Area of a triangle, Area equals 1/2 base x height irregular lots or rooms. Divide the shape into regular rectangles, squares or triangles. Compute the area for each figure. Add the areas together to get the total area for the parcel. You can compute the price per square foot by dividing the sales price of the home or land by the calculated area. The perimeter is the sum of the length of all its sides. An acre of land has 43,560 square feet. Mortgage qualifying. The income ratio establishes the borrower's capacity to pay the loan by limiting the percent of gross income he may spend on housing costs. Gross income is a person's total income before any deductions. Net income is the gross income minus expenses. The guidelines require the income ratio to be no more than 29%. A borrower's debt ratio is based on all of the monthly obligations the borrower has. The guidelines state the debt ratio may not be greater than 41%. Tax rates. Real property transfer tax. The tax is based on the purchase price of the property, except if part of the loan is assumed. In that case, the amount of the assumption is subtracted from the purchase price and the tax calculation is done on the remainder. Mortgage recording tax. The minimum tax rate is 75 cents for each $100 of the amount secured by the mortgage. The maximum amount is $2.75 for each $100. Real property tax rate. The amount of a particular property's tax bill is determined by the property's taxable assessment and the tax rates of the taxing jurisdictions in which the property is located. Assessed value x tax rate equals annual taxes. Click here if you would like to open this summary as a PDF, which you can then print or save to your device. Chapter 22 Summary. Chapter Conclusion. In this chapter, we have discussed commissions, simple interest, discount points, area and length, mortgage and interest payments, different kinds of taxes. In the next chapter we'll be discussing municipal agencies. Now it's time for your chapter quiz. Good luck! 1 of 17. John and Trish obtain a $500,000 mortgage loan for 20 years at a fixed rate of 6%. The amortization calculation indicates their monthly payment to be $2,965. How much will their second month's principal payment be? $466.33. 2 of 17 points that are paid at closing are typically equal to 1% of the loan amount. 3 of 17. If a lender charges 3 points on a $90,000 loan, the borrower would pay points of $2,700. 4 of 17. How much would 3 points cost for a $250,000 loan? $7,500. 5 of 17. A building is valued $380,000 and depreciated over 40 years. What is the depreciated value of the building after 5 years? $332,500. 6 of 17. What is the interest due on a $195,000 loan at 6% for 20 years? $234,000. 7 of 17. A rectangular parcel contains 2.5 acres of land and has a road frontage width of 150 feet. What is the depth of the property? 726 feet. 8 of 17. Mary is getting a $95,000 loan at 7.5% and will pay 2 discount points. What will the effective interest rate be? 0.0775. 9 of 17. Pete and Amanda obtain a mortgage for $205,000 for 30 years at a fixed rate of 7.75%. Their monthly payment amount is $1,468.65. What will the loan balance be after they have made their second payment? $204,709.68. 10 of 17. Beth is getting a $375,000 loan at 6.25% and will pay 2 discount points at closing. What will the effective interest rate be? 6.5%. 11 of 17. The sellers sold their property for $95,000. They pay the broker a 6% commission. How much did they pay in commission to the broker? $5,700. 12 of 17. If Joe sells a property for $375,000 with a 6.25% commission rate, how much commission will Joe receive? $23,438. 13 of 17. Tom is getting a $275,000 loan at 6.5% and will pay 1 origination point and 2 discount points. What will the total point cost be? $8,250. 14 of 17. The Baker home has a value of $200,000. Property in their area is assessed at 70% of its value, and the local tax rate is $25 per $1,000 of value. What will the Baker's annual tax bill be? $3,500. 15 of 17. Harry and Sally want to purchase a home. They have annual gross income of $60,000 and the loan payment they require is $1,650. Which loan would they most likely qualify for? FA. 16 of 17. A rectangular lot measuring 300 feet wide by 600 feet deep is offered for $200 per front foot. The asking price would be $60,000. 17 of 17. Tom and Jen are getting a $175,000 loan at 5% and will pay 4 discount points. What will the effective interest rate be? 5.50%.